Bitfarms stock closed the last trading session on Friday, November 28, 2025, at exactly $3.52 in the after-hours market, following a massive intraday surge where the stock rallied over 12% to close the regular session around $3.48. Since the markets are currently closed this Saturday, these figures represent the most actionable data we have, and the story they tell is nothing short of explosive. If you were watching the ticker tape on your Fidelity mobile app or tracking the volatility on the Robinhood app, you likely saw Bitfarms gap up right at the open, tearing through resistance levels that had held it down for weeks. This wasn't a quiet move. Volume spiked to over 37 million shares, indicating that institutional capital is finally waking up to a narrative that retail investors have been debating in forums for months. The broader expectation for Bitfarms has long been that it is simply a high beta play on Bitcoin's price. If Bitcoin goes up, Bitfarms goes up, and if Bitcoin crashes, the stock gets decimated. That is the expectation. The reality, however, is far more nuanced and potentially more lucrative for those paying close attention. The market is beginning to price Bitfarms not just as a miner of digital currency, but as an emerging infrastructure backbone for the artificial intelligence sector, a pivot that fundamentally alters the valuation models used by analysts at major firms like Interactive Brokers and SoFi Invest. When you look at a chart of Bitfarms, the immediate reaction is often to overlay it with Bitcoin's price action and assume the correlation is 1-to-1. For years, that was the correct move. But Friday's price action signals a decoupling, or at least a divergence based on operational efficiency and strategic expansion rather than just commodity prices. While Bitcoin has been chopping around trying to find direction in this post-halving environment of late 2025, Bitfarms has been executing a boardroom and operational cleanup that has left it leaner and more aggressive. The expectation was that the hostile takeover attempt by Riot Platforms earlier this year would leave the company fractured and distracted. The reality is that the settlement reached in September has acted as a stabilizing force, removing the acquisition premium volatility and allowing management to focus purely on execution. The 12% jump we just witnessed isn't speculation, it's a repricing event as the market digests the fact that Bitfarms is successfully transitioning its Washington site to support high-performance computing workloads. This is where the smart money is looking. They aren't buying a Bitcoin miner, they are buying a power-secure data center operator that happens to mine Bitcoin. Let's break down the trading mechanics we saw on Friday because they offer clues for the coming week. If you use the Interactive Brokers trading platform, you might have noticed the order flow was heavily skewed toward the buy side right from the pre-market hours. The stock opened at $3.38, significantly higher than the previous close of $3.10. This is what traders call a breakaway gap, a technical signal that often indicates the start of a new trend rather than a temporary blip. Throughout the day, the price held those gains, refusing to fill the gap, which is a sign of immense underlying strength. Traders using the SoFi trading platform or checking their Schwab Intelligent portfolios likely saw alerts triggering as BITF crossed the $3.40 threshold, a psychological resistance point that has frustrated bulls for the last 2 quarters. The fact that it closed near the highs of the day suggests that traders were not eager to take profits into the weekend, implying they expect further momentum when markets reopen on Monday. This kind of price action forces short sellers to cover their positions, creating a feedback loop that drives prices higher, a classic short squeeze setup that is often discussed in online investing communities but rarely executed this cleanly. Now, we need to address the elephant in the room, the earnings report from mid-November. The company reported revenue of $69 million, a staggering 155% increase year over year. On paper, this looks phenomenal. However, they also posted a net loss of around $80 million. The expectation here would be for the stock to tank on such a heavy loss. But the reality, and the reason the stock is rallying now, is that the market understands where that money went. It wasn't burned on administrative bloat, it was poured into a massive fleet upgrade and the acquisition of stronghold digital mining. This is the difference between a company losing money because it's failing and a company losing money because it is building a fortress. When you invest online, whether through a simple interface like Robinhood crypto accounts or a more complex Fidelity brokerage account, it is critical to look past the headline EPS number. The massive depreciation charges related to upgrading their fleet mining to the T21 series miners distorted the earnings picture. If you strip away those non-cash charges, the operational cash flow tells a story of a company that is generating cash and reinvesting it aggressively to capture market share from weaker competitors who failed to prepare for the 2025 mining economics. This brings us to the core of the bullish thesis, the fleet efficiency and the post-halving landscape. We are now well past the April 2025 Bitcoin halving, an event that cut miner rewards in half. The expectation was that this would cause a, quote, miner capitulation where unprofitable companies would go bankrupt, flooding the market with distressed assets. While we have seen some consolidation, Bitfarms has positioned itself as a predator rather than prey. By upgrading their fleet efficiency to around 21 joules per terahash, they have ensured that they remain profitable even if Bitcoin price stagnates. This efficiency is the single most important metric for a miner. It's like a trucking company getting twice the mileage per gallon of fuel compared to its rivals. In a commodity business, the lowest cost producer always wins. Bitfarms has achieved this while simultaneously diversifying their energy portfolio away from unstable regions. The move to exit Argentina and focus on the U.S., particularly with the stronghold digital mining acquisition in Pennsylvania, has de-risked the regulatory profile of the stock. Investors using Fidelity Wealth Management Services often look for this kind of jurisdictional safety, preferring U.S.-based assets over those subject to the whims of volatile foreign governments. The strategic pivot to AI and high-performance computing is the true wildcard here. The market is starving for power. AI data centers consume massive amounts of electricity, and securing grid connections can take years. Bitfarms already has the power. The conversion of their Washington site to support NVIDIA GB300 systems is a pilot program that proves the concept. They can lease their power capacity to AI firms for 2 to 5 times the revenue they would generate mining Bitcoin with that same power. This is the arbitrage opportunity of the decade. While the market sees a crypto stock, the reality is an energy infrastructure play. If Bitfarms can successfully transition just 20% of its power capacity to HPC clients, its revenue stability would dramatically improve, commanding a higher multiple from Wall Street. We are seeing early signs of this re-rating now. The jump to $3.52 is the first step in the market acknowledging that a megawatt of power is worth more when it's training an LLM than when it's hashing a block. This hybrid model is what separates Bitfarms from a pure-play miner like Marathon Digital or a pure-play data center REIT. It offers the explosive upside of crypto with the steady, contract-based cash flow of a data center. Let's pause for a moment and look at the broader industry context. The Bitcoin mining sector in late 2025 is fundamentally different from the Wild West of 2021. It has become industrialized and institutionalized. We are seeing a convergence of energy markets and digital assets. Companies are becoming grid stabilizers, turning off their machines during peak demand to sell power back to the grid at a premium. Bitfarms has been a leader in this demand response strategy, particularly in its Quebec and U.S. operations. This ability to monetize downtime is a sophisticated financial lever that retail investors often overlook. When you are conducting your own analysis on investing sites or setting up a self-investing plan, you need to account for these secondary revenue streams. They act as a hedge. If Bitcoin crashes, the energy arbitrage revenue often increases because the opportunity cost of shutting down miners is lower. It provides a floor to the stock price that didn't exist in previous cycles. The relationship with Riot Platforms also deserves a deeper look. The settlement in September 2024 ended a hostile dispute that was weighing heavily on the stock. Riot, a massive competitor, tried to acquire Bitfarms on the cheap. Bitfarms fought back, adopted a poison pill shareholder rights plan that triggered if anyone bought more than 15% of the stock, and eventually forced a settlement that refreshed the board with independent directors. This was a victory for Bitfarms shareholders. It proved that the assets were valuable enough to fight for and that the management was willing to protect shareholder value. Now, with a standstill agreement in place until 2026, Bitfarms has a clear runway to execute its strategy without looking over its shoulder. However, it also puts a floor on the valuation. Riot is still a major holder, and if Bitfarms executes well, they or another major player could return with a friendly offer at a much higher premium. This